Welcome to the deep dive. Ever wondered why some companies, despite huge revenues, sometimes face a sudden cash crunch?
hmm
Or how uh, seemingly simple terms like hash on a financial statement can actually hide some really crucial complexities?
Absolutely. It's not always as simple as it looks.
Exactly. So today we're unlocking the hidden language of cash and cash equivalents. It's a fundamental concept, really, that shapes how we understand a company's immediate financial pulse. And its strategic flexibility, too.
It really does. It's foundational stuff.
Before we dive deeper, though, just a quick reminder that this deep dive is based on material from Farhat lectures. All content, examples, and explanations discussed here are derived from the comprehensive accounting resources over at farhatlectures.com. So whether you're an accounting student, maybe a CPA candidate, or even a professional, do visit the website for additional practice questions, video lectures, and detailed support to reinforce today's topic. Special thanks to Professor Farhat for providing this valuable material.
Great resource.
Okay, so let's kick things off with the most basic piece, cash. When accountants talk about cash, it's a bit more precise than just the bills in your wallet, isn't it?
Oh, definitely. It's more specific than just physical money, yeah.
So what does it actually encompass?
Well, for accountants, cash includes currency and coins, sure, but also checks a company has received and, can deposit immediately. Plus, demand deposits, think of the funds readily available in a company's checking or savings accounts.
Right, readily available.
Exactly. The defining characteristic here is immediate availability for use. It's liquid, it's ready for any operational need, basically.
Okay, so cash is straightforward, ready access.
Mhm.
But cash equivalents, that's where things get a bit more nuanced, right?
Oh.
And frankly, more interesting for analysis.
Mm.
What exactly is the line? What makes an investment crossover to be considered as good as cash for reporting?
Yeah, that's where the specific criteria come in. Cash equivalents are these very short-term, highly liquid investments. There are three critical hurdles an investment must clear.
Okay, three hurdles.
First, it has to be easily convertible to known amounts of cash. You need to know what you're getting back.
Known amounts. Got it.
Second, and this is absolutely vital, it must have an original maturity of 3 months or less.
Original maturity, not remaining maturity.
Correct. That original maturity part is key. It's about the maturity at the time you buy it, not how long is left on it today.
Ah, okay. That's a critical detail.
It really is. And third, it must pose an insignificant risk of changes in value. You don't want its price jumping around.
Right, low risk.
Exactly. Because they meet these pretty stringent conditions, they get lumped in with cash on the balance sheet. They represent sort of immediate financial firepower.
Okay, so to make this tangible for everyone listening, give us some prime examples. What kind of instruments are we talking about that fit these criteria, the kind you'd actually see?
Sure. Think about government-issued debt, like Treasury bills or T-bills.
T-bills, right.
They're incredibly low risk, often have very short maturities, like 30, 60, 90 days. So perfect. Many companies use them to temporarily park excess cash, maybe buy some 60-day T-bills.
Makes sense. What else?
Then there's commercial paper. These are short-term, unsecured promissory notes issued by large, creditworthy corporations.
By big names.
Yeah, exactly. A company like, say, Microsoft or Apple might issue 45-day commercial paper. Investors buy it for that quick liquidity.
Okay.
We also see money market funds. These are pooled investments designed to maintain a stable net asset value. They offer stability and quick convertibility, great for idle corporate cash.
Oh, like keeping cash safe but maybe earning a tiny bit of interest?
Pretty much, yeah. And then certificates of deposit, CDs, can qualify, but
There's a catch?
there's a catch. Only if their original maturity is 3 months or less. So a business might buy a 90-day CD from a bank like JP Morgan, and that would count.
90 days.
Okay, but not longer. Finally, repurchase agreements or repos. Financial institutions often use these for very short-term borrowing, sometimes even overnight. If a repo, say a 7-day one, has securities as collateral and meets that 3-month or less original maturity rule, it's also a cash equivalent.
Wow, okay. So quite a few specific types there.
Mm-hmm.
So if we know what is included, let's flip it. What are the common traps?
Yeah.
What often gets confused but definitively isn't cash or a cash equivalent?
Wow.
This must be where the tricky exam questions pop up, right?
Well, absolutely. This is a crucial distinction to make. First off, any restricted cash is out.
Restricted cash, what does that mean exactly?
It's money that's earmarked for specific uses. Maybe it's held in an escrow account for some legal dispute, or it's a compensating balance required by a bank on a loan. Point is, it's not available for general operations,
Right.
so you can't call it cash for reporting purposes.
Okay, so tied up money doesn't count.
Right. Also, things like post-dated checks someone gave you.
Checks you can't cash yet.
Exactly. Or IOUs, just informal promises to pay back money. They don't count because they aren't legally collectible or liquid until some future date.
Right, you can't spend an IOU today.
Nope. And critically, investments with volatile value, think common stocks, corporate bonds with longer maturities, or most cryptocurrencies.
Definitely not cash equivalents.
No way. They clearly fail the insignificant risk of changes in value test. Their value can fluctuate wildly, sometimes dramatically. You just wouldn't group them with your most liquid assets. And always remember that original maturity rule. So a 120-day CD.
Too long.
Too long. A bond maturing in 6 months.
Also too long.
Right. Even a money market fund, which usually qualifies, would be excluded if it imposed, say, restrictions on withdrawals, because then it isn't readily convertible to cash.
Ah, okay, so that convertibility point is key too.
Absolutely.
That attention to detail really matters then. For you listening, whether you're analyzing a company's financial statements or, prepping for a professional exam, why is making these precise distinctions so incredibly crucial?
Well, if we connect this to the bigger picture, understanding these precise definitions isn't just, academic. It directly impacts how a company's liquidity is assessed.
By who? Investors, creditors.
Exactly. Investors, creditors, analysts. When you look at a balance sheet, that cash and cash equivalent line gives a snapshot of a company's immediate financial flexibility. Misclassifying an asset could paint a really misleading picture. It could make a company seem more liquid than it actually is.
Or maybe less liquid.
Or vice versa, right?
Right.
Which directly impacts investment decisions, lending decisions, everything. And look, for anyone on the CPA journey, this is absolutely foundational. It's tested under both FAR and AUD sections. You'll see it in simulations where accurate classification and presentation are just vital. You really need to know this stuff cold.
So it really changes the perception of a company's financial health, doesn't it? It may be a subtle analytical insight that often gets missed when people just glance at this line item.
That's a great question. A subtle but powerful insight often missed is this. While a large cash and cash equivalent balance signals strong liquidity, which is good,
Yeah.
sophisticated analysts also look at the composition of those cash equivalents.
Like what kind of equivalents they hold.
Exactly. A portfolio heavily weighted towards something like, say, commercial paper might signal a different risk appetite or short-term strategy than one dominated by super safe T-bills, even if both technically meet the cash equivalent criteria.
Interesting.
Yeah, so it's not just the total number, but what makes up that total. That tells a deeper story about a company's financial strategy and maybe its view on short-term risk.
That's a really good point. So our deep dive today has really highlighted the critical importance of these precise definitions for cash and cash equivalents. We've seen how absolutely vital that concept of original maturity of 3 months or less is for an investment to qualify, along with, high liquidity and minimal risk.
And hopefully with this exploration, you're now equipped with a much more solid understanding of a crucial accounting concept. It really underpins so much of financial reporting and analysis.
Definitely. So here's something to think about. The next time you encounter a company's financial statements, or maybe even when you're just managing your own short-term funds, consider this. How might a subtle misclassification of cash or cash equivalents, maybe putting something in that shouldn't be, or leaving something out, how might that impact the perceived stability and operational flexibility of that entity?
Yeah, that's a great takeaway. It's often a hidden story there.
It really is. A hidden story just waiting to be read. Keep exploring, keep questioning, and keep diving deep into these fascinating topics.